If you've looked at the markets lately, you've probably felt that sudden jolt, right? Just a sea of red everywhere, headlines screaming about a massive crash. But what if the story those headlines are pushing isn't the real story? Let's put back the curtain and really decode what's going on behind this huge sell-off. So this is the number that's just everywhere, 9 lakh crore. That's how much investor wealth was wiped out in just 5 trading sessions. I mean, it's a staggering figure, and the sheer speed and scale of it has everyone asking the same question: why and why now? Now, the easy answer you'll hear from most people is, oh, high valuations or pre-budget jitters. And look, sure, those things are part of the mix. But here's the thing. Valuations were high last month too. They were high the month before that. So what was the actual trigger? The real story? Well, it's probably not what you think. To really get what's happening, we have to look past our own local headlines. See, this isn't just some isolated panic in India. The real engines driving this crash are firing up thousands of miles away in the financial hubs of Tokyo and, you guessed it, Washington. Okay, let's start in Tokyo. The first huge global force at play here is something called the yen carry trade. Now, a sudden, sharp change in how that trade works is forcing this massive, almost relentless wave of selling from foreign investors right here in India. So what on earth is this yen carry trade? Well, for years, the logic was beautifully simple, almost like a money printing machine. Hedge funds could borrow money in Japan at practically 0% interest. We're talking next to nothing. Then they'd take that super cheap money and plow it into high growth markets like ours, making, 12 to 15% returns. It was an incredibly profitable game, as long as things stayed exactly the same. And this right here shows you just how fragile that whole strategy was. All the Bank of Japan had to do was hint, not even act, just hint at raising interest rates. That tiny little signal caused the Japanese yen to strengthen by just a couple of percent. And boom, just like that, the entire math of the trade breaks. All of a sudden, the loan they took out in yen is way more expensive to pay back. And this creates an immediate chain reaction, a domino effect. The Bank of Japan's signal makes the yen stronger. That strength triggers instant margin calls for these big, leveraged funds. And to cover those margin calls, their computer algorithms automatically force them to sell their most liquid, most profitable assets. And for a lot of them, guess what that is? Yep, Indian stocks. All right, now let's pivot to the second major force, Washington. Because at the exact same time all this drama with the yen is unfolding, something is happening with US bonds that's acting like a giant financial vacuum cleaner, just sucking money out of markets all over the world, including ours. The best way to think about it is like this. US Treasury bonds are the safest asset on the entire planet. They are literally the financial world's center of gravity. So when the return on that ultra-safe asset starts to rise, it fundamentally changes the risk calculation for every other investment out there and pulls capital back towards that safe core. This chart just breaks it down perfectly. I mean, ask yourself, why would you risk your capital in a volatile emerging market like India for a 12% potential return when you can get a guaranteed 5% completely risk-free in US dollars? Then, you factor in the rising cost of hedging against currency swings, and that juicy Indian return shrinks to maybe 6%. All of a sudden, the risk just isn't worth the reward anymore. And this gets to the absolute heart of it. This selling spree isn't some vote of no confidence in India's economy. Not at all. It's a desperate scramble for cash. India has been a winning market for these funds, so they're cashing out their winner here to pay for their bond losses and currency problems somewhere else. We are, for all intents and purposes, being used as a global ATM. Now there's a third piece to this puzzle that explains the absolutely terrifying speed of this drop. This isn't just a bunch of humans panicking and hitting the sell button. A huge part of this is happening faster than a person can even think, and it's all thanks to algorithms. What happens is something known as a feedback loop. An initial dip in price triggers thousands of pre-programmed sell orders from trading algorithms. Of course, all that selling pushes prices down even further, which in turn triggers even more algorithmic selling. It becomes this vicious, self-feeding downward spiral. And just look at this timeline. It shows the mind-boggling speed of it all. A key technical level in the market breaks, and within milliseconds, literally faster than you can blink, a massive cascade of automated selling is just unleashed. This has nothing to do with human analysis or emotion. It's pure automated momentum feeding on itself. So with all this global chaos, these dominoes falling, what are we actually seeing? Is this the big one we've all been worried about? Well, this is probably the most important distinction we need to make. What we are seeing is a correction, which is driven by a global liquidity event, not a fundamental crash. See, a real crash like 2008 happens when the underlying economy is fundamentally broken. That's a solvency problem. A correction, which is what's happening now, is when the global price of money changes. It's a liquidity problem. The global financial system is basically having a cash crunch, but the Indian economy itself is still solvent and strong. And that is the key takeaway here. If you look at the actual data, India's domestic economic engine is still humming along just fine. Credit growth is healthy, our GST collections are robust, and capital expenditure is strong. The foundation is solid, even if these huge global tides are pulling money away from our shores for a bit. I think this quote just says it all, really. The selling we are seeing from these foreign funds, it's not a choice. It's not based on their view of India's future. It is a forced reaction to these immense global pressures. It's mechanical, it's mathematical, and for them to survive, it's absolutely mandatory. They aren't choosing to leave, they're being forced to. Okay, so what does all this mean for you as an investor? Well, the biggest takeaway is that the rules of the game have clearly changed. To really understand our own market now, we need a totally new watch list, one that looks way beyond our own borders. It's simply not enough anymore to just track the Nifty or the Sensex. The biggest moves, the biggest risks, and the biggest opportunities in our market are now being dictated by these huge global flows of capital. If you want to see what's coming next, you have to watch the world. And here are the two most important dials you need to have on your new global dashboard. First, the relationship between the US dollar and the Japanese yen. This tells you everything you need to know about that carry trade. And second, the US 10-year Treasury yield, that measure of global financial gravity. Honestly, these two indicators alone will give you a massive edge in understanding why foreign money is moving the way it is. Which brings us to our final thought. What this whole event has shown us with brutal clarity is just how deeply interconnected everything has become. And it forces us to ask a really big question. In a world where trillions of dollars can move across the globe at the speed of light, is there really such a thing as a local market anymore? Something to think about.